Okay, video number 5 of the trend series. We are on the letter D. Remember, this series is to establish why I believe the trend for 2016 in the market will be down. I think this will be entrenched by the last quarter. The market obviously started off with its worst in history. It's bounced back and we are setting new highs. I don't think anybody's really making any money at these new highs. After all, the high of 2175 on the S&P 500, we were at 2075 in December of 2014. So in this year and a half, we moved a whole whopping 100 points. That's not making money. So we come to the D in trend, and the D stands for debt. Now I'm going to use a bunch of different analogies on this because when we're talking in the trillions of dollars, it's really difficult to wrap your brain around those numbers. So I'm going to use an analogy to help you understand why I think this is so critical. But look, we could list the different categories of debt that is not only choking the life out of our economic system, but pose a flashpoint that could bring this entire marketplace down. We could talk about bank debt. I've blogged about the 8 systematically important banks in the United States. Of those 8, 5 are insolvent right now, 2 are almost insolvent, and only 1 is stable. This is according to the Dodd-Frank law that establishes solvency rules and bankruptcy. Last week, under negative rates, I talked about the 5 European banks that their stock prices are all down between 52 and 64%. So we can talk about bank debt. We could also talk about the frackers, the U.S. oil fracker debt. They have taken on $550 billion in debt since 2009 to build their oil infrastructure that is not being serviced. Ever since oil went below $90 a barrel, they have not been able to service this debt. We could talk about student loan debt that is now approaching the housing crisis level. If you remember, the housing crisis was $1.7 trillion when it collapsed. I don't know if you realize it or not, but there's a website that you can follow the student debt clock, and here it is. You can see I'm having it live. We're approaching $1.4 trillion in student loan debt. We could talk about auto loan debt that is approaching this number that is questionable how serviceable it is, meaning are people actually paying the loans back at a level that is profitable to the banks, which ties right back into this issue. But the big one we have to talk about is the Federal Reserve. How the Federal Reserve has put us in to debt to the tune of $20 trillion in stimulus, trying to make our economy grow, trying to create what? You've seen me talk about this so often. They're trying to create inflation, and have they been successful? No, they have not. They failed. So here's the analogy I want to talk about for going back to 2008. Let's say you have this big tree in your backyard and you have a neighbor who's kind of they have a kid who's kind of rambunctious. He doesn't listen and he's always wanting to climb your tree. And you tell him, don't do it. It's dangerous. You might hurt yourself. Well, sure enough, this kid climbs up the tree and he gets to this branch right here. Okay? And what happens? He slips and falls just like you thought you would. But what happens? He slips and he falls and he crashes and he lands right here on this branch. He's a little bruised, but nothing bad happened. Now, if he didn't land on this branch and he went all the way to the ground, he would have broke his leg. Lesson learned, you would have said. But when you look at the 2008 collapse, this is what represents the 2008 collapse. The Federal Reserve stepped in and they put this support in of all this stimulus that kept people and institutions from hitting the ground and learning their lesson. So to save the day, they started pumping all the stimulus in, trying to pretend that this never happened, that this fall never happened. Well, it did happen. And by doing the stimulus, the lesson wasn't learned, and so this is what happened visually. This little character right here, this guy, because he didn't get hurt, guess what? He went to climb the tree again. But now, this tree height, it's not this branch level. Now, it's so high. When I compare this to trillions, I mean, this tree can be so high, it's actually quite startling. So let's say he's up to this branch now. Now I'm going to put him out here hanging because literally that's what I feel like is happening. So here, when he fell from here to the ground, he would have broke his leg. When you fall from this height, right? When you fall from that height, you don't break a leg, you shatter everything. And that's the problem with the debt we are under. Now, the Federal Reserve and all the other central banks, they think they can still save the day. That's why I talked about negative interest rates and so forth. But folks, it's just too much. This is just our country. It's just too much. So I've written plenty about this, and I'm sure by this time you're saying, okay, Rob, what do I do? What do I do? Question mark. Well, there's only so much I can cover in a video, and I try to keep these short. One thing you can do is you can go to the Brinkman Academy. In fact, here I'll just show you. You can go to the Brinkman Academy and you can download this ebook that I wrote, The Top 3 Ways to Guarantee a Comfortable and Secure Retirement. I get into some of the financials of how we manage money that will help you navigate the markets, whether the trend is up or the trend is down. If you look at our low risk portfolio, these are our bond managers, but the important thing is these bond managers can go inverse, meaning as markets go south, they can actually make you money. And look at the year-to-date numbers. Up 1, up 3.3, up 2.2, up 8.8, up 607, up 2.1, up 5.36. Are your bond funds doing this? No, they're not. And this is a difference of using private wealth managers versus mutual funds. And I've written plenty about this, that mutual funds get killed in these down markets, right? Because they have to be fully invested. Gold. I've written so much about this. I talk so much about this. So let's touch on a couple things. And we'll go back to our tree analogy here. If a tree is an investment on the upside, on the what's called the long side, if you are long the investment, there is unlimited potential. If you buy a stock or you buy gold, it can go up in price at an unlimited amount, right? There's no ceiling. It can go into infinity theoretically. But guess what? Ground here, this is zero. A stock or gold can't go below zero. So when it comes to the bid and the ask, remember, it's not just you investing. Whenever you want to buy or sell something, there's somebody very smart on the other side that's going to fill that order. If you're on the long side and markets are going up, there's plenty of liquidity. There's always a bid and an ask. But when you get down to zero, when there's very little liquidity, meaning there's very little bid and ask going on, this is when true panic sets in. And this is when prices crater overall. This is why I've spent so much time talking about negative interest rates, because here it is. This is zero. Interest rates are supposed to be somewhat above that. In fact, we know they could go into infinity. I mean, the United States have never seen interest rates much beyond the 16 to 18%. We saw this in the late 70s, early 80s. But, theoretically, it can go to 100 if it wanted to, right? But it's not supposed to go below zero. And that's what some of these central banks have done, is they've gone into negative territory. Once you're at zero or negative, guess what? The bid and ask dry up. So when something happens, when a Shearson Lehman goes bankrupt or something else shocks the system, the liquidity dries up, panic sets in, and that's when prices absolutely fall apart. So in this scenario, gold will go through the ceiling. Another reason gold, I believe, is going to go up. And it gets back to what I talked about with the banks earlier, whether it's the United States banks or the European banks. These banks are buying gold like crazy. Why are they putting gold on their books? Well, think about it. Think about a simple financial statement, right? You have assets and you have liabilities. Over here, they are so over the top in debt, right? I told you about Deutsche Bank. Just remember, when Shearson went bankrupt, their debt to equity ratio, their leverage was 31. They owed $31 for every $1 they had in capital and equity. Deutsche Bank today is at 40. So there's an incredible amount of debt on these bank balance sheets. And over here on the assets, well, they own things like stocks and bonds and real estate and so forth. But what happens if they own gold and these central banks decide, you know what, we have failed at creating inflation, so why don't we manufacture it by arbitrarily increasing the price of gold? If they raise the price of gold by a factor of 10, what happens to this balance sheet where there's all this debt over here and a little bit of gold, and all of a sudden the gold goes up by a factor of 10? Does this balance sheet look healthy all of a sudden? You bet it does. So don't think that this stuff can't happen. So you need to pay attention to owning gold. Whether you buy it as an investment or you buy the actual physical gold, you need to wake up and you need to start paying attention to this. So I know this gets kind of thick in the weeds and it's difficult for me to give individual investment advice. Obviously, just reach out to us if you want to have a conversation, you want us to do an analysis of what you have. Happy to do all of that. But the reason we did this trend video series is there's a problem. This is all going to come to a head, and this is the main driver. You can't avoid it. The debt is there. Something has to happen. And whatever ends up shocking the system, it's going to be the central banks that are going to be calling the shots, and they are going to do a massive coordination of all the different currencies, and they're going to do something about this debt because it's on their balance sheets, right? They have to address it. So hopefully you won't be mad at me for being a Debbie Downer. I just wanted to open your eyes to what's going on here. As always, go to the Brinkman Academy to subscribe, watch our other videos, contact us for a free consultation or an analysis. I appreciate you hanging in and watching this trend series. We'll talk to you soon.